Need money for a car, college, or a home? Don't pick the wrong loan and regret it later. Let me break down 18 types of loans and which one fits your need best. Personal loan. A personal loan is an unsecured loan given based on the borrower's creditworthiness and income without needing collateral. It can be used for various purposes, such as debt consolidation, medical expenses, home renovations, or other personal needs. These loans typically have fixed interest rates and set repayment terms ranging from 1 to 7 years. Approval and interest rates depend on the borrower's credit score, income, and overall financial health. Mortgage loan. A mortgage loan is a secured loan used to purchase real estate, with the property itself serving as collateral. Mortgage loans generally have long repayment terms, such as 15 or 30 years, and can have fixed or adjustable interest rates. Fixed-rate mortgages offer consistent monthly payments, while adjustable-rate mortgages have fluctuating rates. The borrower's credit score, income, and the property's value influence approval and interest rates. Auto loan. An auto loan is a secured loan used to purchase a vehicle, with the car itself serving as collateral. These loans typically have terms ranging from 2 to 7 years and come with fixed interest rates. The loan amount, interest rate, and repayment schedule depend on the borrower's credit score, income, and the vehicle's value. Student loan. Student loans are designed to help cover the cost of higher education. They can be federal or private, with federal loans often offering lower interest rates and more flexible repayment options. These loans cover tuition fees and living expenses. Repayment usually begins after graduation, and terms vary based on the loan type and lender. Payday loan. Payday loans are short-term, high-interest loans intended to cover expenses until the borrower's next payday. They are typically for small amounts and must be repaid quickly, often within 2 weeks. Due to their high fees and interest rates, payday loans can lead to a cycle of debt if not managed carefully. Home equity loan. A home equity loan is a secured loan where the borrower uses the equity of their home as collateral. It provides a lump sum that is repaid over a fixed term, usually with a fixed interest rate. Home equity loans are often used for significant expenses like home improvements, medical bills, or debt consolidation. Home equity line of credit. HELOC. A HELOC is a secured loan similar to a home equity loan, but functions like a credit card, allowing the borrower to withdraw funds as needed up to a certain limit. The interest rates are usually variable, and repayment terms can vary. HELOCs are often used for home improvements or major expenses. Small business loan. Small business loans support the financial needs of small businesses. These loans can be used for startup costs, expansion, equipment purchases, or working capital. They can be secured or unsecured, with terms and interest rates varying based on the lender and the borrower's business plan, credit score, and revenue. Debt consolidation. A debt consolidation loan combines multiple debts into a single loan with one monthly payment. This can simplify repayment and often results in a lower overall interest rate. It can be a secured or unsecured loan, depending on whether collateral is required. The goal is to manage debt more effectively and reduce interest costs. Credit card loan. Credit card loans or credit card advances allow cardholders to borrow against their credit limit. The borrowed amount must be repaid with interest, which is typically higher than other forms of credit. These loans provide quick access to funds but can lead to high-interest debt if not repaid promptly. Bridge loan. A bridge loan is a short-term loan used to bridge the gap between the purchase of a new property and the sale of an existing one. These loans have higher interest rates and are secured by the borrower's current home. They provide temporary financing until permanent financing can be obtained. Construction loan. A construction loan is a short-term loan used to finance the building of a home or other real estate project. It covers the costs of construction and is usually converted into a mortgage upon completion. These loans have variable rates and are dispersed in stages as the project progresses. Title loan. A title loan is a short-term loan where the borrower uses their vehicle title as collateral. These loans typically have high interest rates and short repayment terms. If the borrower defaults, the lender can repossess the vehicle. Title loans provide quick cash but can be risky due to high costs. Secured loan. A secured loan is any loan that is backed by collateral, such as a car or house. This reduces the risk for the lender and often results in lower interest rates for the borrower. If the borrower defaults, the lender can seize the collateral to recoup their losses. Unsecured loan. An unsecured loan does not require collateral and is based solely on the borrower's creditworthiness. Personal loans and credit card loans are common types of unsecured loans. These loans typically have higher interest rates compared to secured loans due to the increased risk for lenders. Line of credit. A line of credit is a flexible loan that allows the borrower to withdraw funds as needed up to a certain limit. The borrower only pays interest on the amount drawn, not the entire credit limit. It can be secured or unsecured and is often used for ongoing expenses or emergencies. Microloan. Microloans are small loans typically used by entrepreneurs and small businesses for startup costs or expansion. They are often provided by nonprofit organizations and have favorable terms for borrowers with limited credit history. Microloans can help businesses grow and establish credit. Agricultural loan. Agricultural loans are designed to support farmers and agribusinesses. These loans can be used for various purposes, including purchasing equipment, livestock, seed, and land, as well as covering operational expenses. They can be secured or unsecured and often have favorable terms to support agricultural productivity.